Central banks are among the most powerful institutions most people are never taught to question. They rarely make headlines, they never run for election, and most people couldn't clearly explain what they actually do. But the truth is they have enormous influence over the value of your money, the direction of the economy, and everything you've worked so hard to earn. They can create money out of thin air or trigger massive changes almost overnight. And perhaps the most surprising part is this: they don't answer directly to you. This is the story of how central banks became the driving force behind modern finance. Not as neutral referees, but as some of the most influential players in a game they helped create. It's a story of hidden power, financial engineering, and what many call the illusion of stability. And once you understand how it all began, you may never look at your paycheck, your debt, or your savings the same way again. Let's go back to the year 1694. England's treasury was running dry. The crown had just come out of an incredibly expensive war with France, and the government's finances were nearly exhausted. That's when a very different kind of bank was created. It wasn't designed to serve ordinary people. Its purpose was to lend money to the government and profit from doing so. That is where the foundations of the modern central bank were laid. Not as a guardian of stability, but as the government's financier. As time passed, that power only continued to grow. By the 19th century, many central banks across Europe had adopted a similar model. Privately owned institutions with special privileges. They issued currency, managed reserves, financed governments during times of crisis, and in return gained extraordinary influence, often with very little democratic oversight. The story unfolded differently in the United States. Americans had always been deeply suspicious of centralized financial power. The country's first two central banks were shut down after accusations of corruption and serving elite interests. As a result, for much of the 19th century, the United States had no central bank. Its financial system became a chaotic mix of private currencies, speculation, and repeated financial crises. Then came the panic of 1907. The crisis became so severe that private financier J.P. Morgan had to organize the rescue himself. After that, many believed a new system was necessary, and in 1913, Congress passed the Federal Reserve Act. The Federal Reserve System was born. It was presented to the public as a decentralized network of regional banks that would bring stability to the economy. But over time, it evolved into a powerful institution controlling interest rates, credit, and the money supply. This is where the story becomes even more interesting. The Federal Reserve isn't exactly a government agency. It's an independent system that combines both public and private elements. Its board of governors is appointed by the president, but its member banks are privately owned. It isn't funded by taxes. Instead, it earns income from interest on government securities and fees charged to banks. And behind the scenes of the financial system, it makes decisions that affect millions of people. So, who ultimately benefits? Officially, the Federal Reserve has two primary goals: maximum employment and stable prices. But critics argue that many of its actions end up benefiting the very financial institutions it is supposed to oversee. During the 2008 financial crisis, it didn't simply lower interest rates. It created trillions of dollars. It rescued investment banks. It supported asset prices, and it absorbed troubled debt. In 2020, similar measures were taken again. Corporate bonds were purchased. Massive amounts of liquidity were injected into financial markets. Asset prices climbed once more. And while people who owned assets became even wealthier, everyone else was told to be patient. This is where the bigger picture begins. Central banks don't just manage the economy, they also shape its direction. When interest rates fall, stock markets often rise. When rates increase, markets become more volatile. When money is created, asset owners tend to benefit. When borrowing costs rise, mortgages, credit cards, and other loans become more expensive for everyone else. And although central banks describe themselves as independent, their relationship with the financial system is deeply interconnected. Executives regularly move between investment banks and central banks, and the technical language they use often makes the system difficult for ordinary people to understand. Today, central banks are more powerful than at any other point in history, and many believe they are also less questioned than ever before. The Federal Reserve, the European Central Bank, the Bank of Japan, the Bank of England. These aren't simply institutions that print money. They are among the most influential architects of today's monetary system. Especially since 2008, The global economy has entered a completely different era. Low interest rates became normal. Quantitative easing became routine. Trillions of dollars were created to purchase government bonds as well as corporate debt. As a result, stocks, real estate, and other assets surged in value. For asset owners, it was an incredibly profitable period. For everyone else, life simply became more expensive. Buying a home became increasingly difficult. Returns on savings nearly disappeared. The cost of living continued to rise, and most people never questioned why. Instead of looking at monetary policy, they blamed something else. Perhaps that's the most important point of all. The modern financial system wasn't designed to make you completely free. It was designed to keep the system running. Debt is encouraged. Saving is rarely rewarded. Interest rates are adjusted. Liquidity is injected into markets, and all of it is presented as stability. But the stability being protected isn't always yours, because when a crisis arrives, central banks move to protect the system first. The banks, the financial markets, the debt-based economy. The events of 2020 offered one of the clearest examples. Financial markets recovered quickly, but millions of people lost their jobs. Thousands of small businesses disappeared. Meanwhile, debt continued to grow, and the system became even more dependent on central bank intervention. When the cost of money changes, almost everything changes with it. Home prices, loan rates, returns on savings, investments, retirement planning. All of these are influenced by decisions made by central banks, yet most people go through life without ever realizing it. So who really controls central banks? Officially, they are independent, but critics argue that they remain closely connected to the financial system that created them. The constant movement of executives between Wall Street and central banks is one of the most frequently discussed examples. But you're no longer completely outside that system, because once you begin to understand how it works, you start seeing it from a very different perspective. Financial education isn't just about budgeting or investing. It's about understanding how money really works, questioning where inflation comes from, recognizing how interest rate decisions shape your everyday life. Maybe it means owning assets that can't simply be created out of thin air. Maybe it means building income streams that don't depend entirely on debt-driven cycles. And maybe it means realizing that endless borrowing isn't the only path to prosperity. So what can you do? Start by seeing the system for what it is. Central banks aren't untouchable institutions. They're players in the system too. Their tools weren't designed primarily to maximize your financial freedom. They were designed to keep the system functioning. You may not be able to change that system on your own, but you can become more resilient within it. Diversify what you own. Reduce unnecessary debt. Learn how money really works. Share that knowledge with others, and never stop questioning the stories you're told. Because when the next crisis comes, central banks will most likely do what they've always done: protect the system. Protecting yourself, however, is your responsibility. History may not repeat itself exactly, but if you fail to understand it, you may find yourself repeating its consequences. If this video gave you a new perspective, don't forget to subscribe. History has the answers, and together, we'll keep discovering where to find them.